this panel is going to dive into a part of the crypto world that often doesn't get a lot of attention, but maybe it should, and that is market neutral investing. So most of the headlines that you hear about crypto speak to directional trading, the wild volatility that comes with crypto markets, token pumps, et cetera, all that kind of stuff. But there's a whole category of managers that are focused on generating steady, low volatility returns. And so that's what we're going to focus on today. And they're able to do that in all kinds of markets, whether they're going up, down, sideways, whatever. And with me on the panel, we're really fortunate to have two great practitioners in the space. My name is Philip Simotas. I'm one of the founding partners of Newform Liquid Capital Management. I started the firm 3 years ago with my partner, Srini Dulapala, who's going to be speaking and hosting a panel later today. We operate a multi-manager fund. And Srini and I are on a mission at this conference and previous conferences to raise the profile of the liquid trading space. And so we're really happy to have this panel and other panels at this conference today. So we operate a fund called the Newform Liquid Opportunities Fund. Both Srini and I come from the hedge fund world ourselves. We both have operated independently our own hedge funds for many years, measured in decades. The fund that we set up is organized into two share classes. We have a share class that's devoted to directional managers, and then we have another share class that's devoted to market neutral strategies. And we have two of those managers here with us today. So today I'm joined by Shiliang Tang from Monarq Asset Management and Paul Howard from Wincent. These guys are really good at what they do, so I'm really happy that they could join us. And we're going to talk a bit about how the strategies work, how they manage risk, what investors should really look for when they're considering this space, and so we'll talk about all that stuff. But first, I'm going to allow them to introduce themselves and talk a little bit about their fund, and then we'll talk a little bit more about their investment processes. So, Paul, you want to start?
Thank you. Well, I think standing on the shoulders of giants is the phrase that they use. So I'm fortunate to be here with such an eclectic and accomplished group of people in the community. And it's great to be here in Chicago, all the way from rainy London to the windy city. I think maybe just some background about Wincent, less so about myself. I come from a TradFi background at Morgan Stanley and Goldman Sachs, but got into crypto in 2012. Wincent was set up in 2016. I was an investor into the fund, and recently, a year and a half ago, joined as director for running our business strategy and business development. We currently have 750 under management, which I think makes us probably the second biggest pure digital asset fund, if you take out the likes of Brevin and people like this. And the group, I say group because originally it started as three brothers, and we're now 120 people. Have been returning 52% annualized every year, the last 7 years. And we do that on a Sharpe of 4.6. If you include the FTX drawdown, it drops to 2.6. But that's still kind of outpaced versus what a lot of TradFi managers see. And then on the background to that, our core strategy is obviously a market-making, market-neutral style of trading. So I'll go into a little bit of detail about that today. I won't give away too much secret sauce from Wincent, but I'll talk a lot about what our competitors do.
Yeah, great. Thank you. That's a good intro. Shiliang?
Yeah, thanks again for having me. And we've known Wincent for a long time in this space, and they're definitely the best at what they do. My background is I spent most of my career in traditional markets, previously on the HFT vol trading algo side of things. Launched my first fund called Ledger Prime. It was like a multi-strategy hedge fund within crypto, mostly market neutral, but we did some directional and venture as well. Ended up selling that in 22. And MNC, now rebranded to Monarq, is a relaunch and continuation of that with many of the same investors, employees, and strategies. We're, as of recently, majority owned by FalconX. And I separately had a business called Arbalest Markets, which is a more client-facing business on the derivatives franchise side of things that we sold to FalconX as well. But similar to Wincent, we do a lot of market-neutral strategies as one of our core main funds. We take more of a multi-strategy approach, so we do market making, but we also do funding rate, options, DeFi, stat arb, cash carry. Historically, at Ledger Prime, we returned something about 40% annualized. And then last year at Monarq, we returned about 50%. Less so this year. It's a tougher market environment. But I think we're taking similar philosophies and approach to the market as Wincent.
Thanks. So I have a slide. Can we cue that? Right. So I just wanted to give the audience a sense of the context of what we're talking about here. This is a picture of the types of returns that are available in market neutral. Now, this is not perfect. The data out there on managers, this is a bit of a cat herding exercise, but we did the best we could in terms of gathering a broad swath of information so that the audience could get a sense of the types of returns that these managers are generating. So what we did was we aggregated all the managers that we could find over the last 5 or so years. This is in the market neutral space. And just did a simple average return of those managers as a group. And so, this is going back to 2020. And in the table on the left, you can see the number of funds that are reported, that are included in this survey. Now, I have to be honest, when Srini and I first started this project back in early 2022, I wasn't sure we were going to find 10 managers in this space. But they're out there. If you go out and knock on enough doors and do a little digging, you can find them. We ourselves have probably talked to close to 200 of them, managers in the both directional and non-directional space. But this is just the the market neutral managers. And so you can see the returns that they generate at the volatility that they take on to generate that type of return is really attractive. And I think that compares really favorably to any managers across all types of asset classes, all types of traditional asset classes. And when you look at the histogram on the right of the dispersion of the returns that you see from these managers, it's equally compelling. So this is I wanted to lay the groundwork for everybody in the audience so they know the scope of what we're talking about in terms of returns. So for me, this area is particularly interesting because I grew up in the FX industry. There are I find a lot of similarities between crypto today and what the FX market looked like 20, 25 years ago, maybe 30 years ago even. I've been around a while. So a lot of the things that I used to do as a practitioner in the market, I find these guys are doing and practicing it at an even more efficient rate. So maybe we could talk in a little more detail with each of you in terms of what exactly are you doing inside of your funds? Just to give the audience a sense of what the opportunity is and what is the edge that you have and what's the alpha that you're trying to extract from the market.
Yeah, I'll happily take the first question. I think first of all, understanding how the perpetuals market works is important because that's a unique concept in this space. And what we've noticed, I think, along with the previous panel, was the inefficiencies in the market. And as Pranav said, the opportunities and the alpha that he can see in the market, because you've effectively got exchanges trading 24/7, across the world, multiple exchanges, multiple jurisdictions, and you inevitably get price discrepancies between them. And so being able to leverage those price discrepancies, extract alpha from those, buying on one exchange, selling on the other, and then complementing that perhaps with the basis trade, and obviously collecting the funding rates, really helps run a balanced portfolio of what I would describe as effectively high-frequency basis trading across multiple exchanges.
So maybe for the audience that are less familiar with the crypto market, what does basis trade mean in crypto?
Yeah, so you're effectively you're going long the spot, you're going short the perp, so you're trying to balance yourself out, and you're making the alpha, as it were, on the funding rate that is paid out on the perpetuals. So typically the long holders we're paying the shorts in a market that's trending up because the futures are priced above the spot price.
Very good. Shiliang, now your strategy encompasses lots of different things, but maybe you could touch on 2 or 3 of them and just maybe in a little more detail explain to the audience what exactly you're doing and how you generate your returns.
Yeah, I think we've done when I first started my first firm, Ledger Prime. I think we always took the approach that over time have become extremely competitive, right? And it has since 2017. I think in 2017 you could literally click, trade, and do exchange arbitrage between different exchanges, and that's largely compressed, right? And we've taken the philosophy that we need to build a more scalable firm and more scalable strategy set. And so I think what we've done is from cycle to cycle, year to year, followed where capital generative is flowing, whether that is in terms of volatility, in terms of institutional capital, and more important in terms of where retail is participating, right? At the end of the day, I think we are all, it's much more profitable to trade against, let's say, retail versus then the institutional market makers, right? So for us, when we first started the firm, sure, we're doing a lot of market making, exchange arbitrage. I think we've, to a certain extent, tapped out on that in terms of just how competitive that's gotten. Over the years, we've migrated to options, which is my background and other members of my team's background. But even that, right? Bitcoin's a 30-vol asset now. There are tech stocks that are trading much higher than that on a day-to-day basis. And so this cycle, more than any other cycle, one opportunity we've seen, and it kind of goes back to what Pranav was saying and about the altcoin markets, is that there are a lot of, call it, inflated valuation tokens that are owned by venture funds, foundations, et cetera, that are looking for liquidity, right? And either they know it's inflated or they just need liquidity, whatever that might be. I think they're being a lot more aggressive about selling this in the secondary markets. And so for a firm like ours, we can effectively buy those at a discount, hedge it with perps, lock in the discount, and basically generate returns, in that regard, right? And that's one form of a basis trade. Obviously, there's risk to that in terms of credit quality and counterparty risks and managing your margins on exchanges. But that is one opportunity set that we've seen the past couple of years more than we've seen maybe in 2019 or 2020.
So 2 other topics I thought it would be important to cover with both of you are obviously is risk. What are the risks and risk management? So let's start with that first. And then after we go through that, I want to talk a bit about infrastructure, because I think that's really important with respect to what you guys and what the community does. So why don't we talk about risk and risk management, and how do you, what has Wincent identified as the critical risks that you have to manage, and how do you do that?
Yeah, exchange risk is a massive problem, right? So you just have to look back 4 years and see the mess that happened there and how our Sharp contracted by almost 50% on that one event. So
talking about FTX.
FTX, obviously, yeah. So that's that. Yeah, I'll not swear. That exchange, leaving assets on exchange is a big risk for us. And the counterparty exposure, and how do we minimize that? Well, we have limits in place of how much we will put on one exchange. Despite there being a big opportunity there, we won't go over that threshold. We've also got in-house risk management systems that help reconcile and manage ourselves. We've got multiple on and off ramps for banking services, because if you remember what happened with Silvergate and those problems back 3 years ago. And then I think we also just take an approach to investing that's a bit different to some of our competitors. We will just market make really the top 20 tokens. We don't go much down the value curve. A lot of our competitors are doing the token market making game, which is, from our perspective, a dump on retail. And as a regulated fund with investors and funds of funds in our fund, we don't really want to be that guy who's dumping on retail or having that perception that you guys are just taking from the market. We'd much rather operate and manage our risk by just operating in those top 20 coins. So that's a bit about how we kind of manage that. I think you mentioned risks, and I think, hopefully not speaking out of turn here, but I think potentially one of the biggest risks that is coming up is this treasury trade that's been very popular the last 6 months. I've mentioned it a couple of times last night over drinks with people, but I think that that's potentially the next 18 months. As we move down the value curve, we move away from BTC, Solana, ETH into these more, let's call them degen coins. You're going to end up with one of these things blowing up at some point, and that's going to, I think, have a cascade on the market with some smaller hedge funds and smaller buyers, which, look, I think that provides an opportunity for people like us to then step in and potentially buy these assets. But you know, when we think about risk, we think about everything from exchange counterparty risk to moving money around to, you know, thematics as well.
Great, thanks. Shiliang.
Yeah, completely agree. I think, you know, at the end of the day, there's a multitude of risks, right? There's exchange risk, counterparty risk, regulatory risk. Like, you know, taking a step back, like, why have, you know, funds like ours been able to generate the returns that we have over the years, right? I think, you know, obviously we're very good at what we do, but a large part of that is also just, you know, a lot of the institutional smart money that are outside of crypto just haven't been able to participate over the years in a meaningful way to compress returns as well, right? And why haven't they been able to participate? You know, regulatory risks, exchange risk, counterparty risk that they're not comfortable with, right? And as those disappear, returns will naturally compress, right? And we already have seen in certain segments, you know, cash carry trade, 2021, you know, months on end, you could generate 30, 40, 50% or more in Bitcoin, ETH. That has compressed like extremely quickly. You know, we got a spike in last year during the elections, post-elections in 2024. But now, you know, institutional capital outside of crypto can easily move very quickly and compress those returns to take advantage of that versus, you know, back in 2020, 2021, they couldn't really. And so, you know, that compression of returns like that is much faster than it ever used to be. And that's a result of, you know, some of the risks that were discussed, you know, lifting a bit as well, right? And I think, you know, post-FTX, despite everything that happened, I think the industry has progressed tremendously in terms of just the infrastructure and everything that's been built to, you know, hopefully mitigate, you know, some of those risks, right? There's a lot of off-exchange solutions that firms like Standard Chartered, Fidelity, these are like highly reputable, highly credit-worthy firms that offer like off-exchange solutions now to enable you to trade on these exchanges without parking your capital onto these exchanges. And so that will be the standard going forward. And so some of these risks naturally get lifted and more, you know, institutional capital continue to flow into the space, which does result in, you know, compressed returns, but hopefully that means it's a much larger pie, you know, for everyone else, right? So
two of the things that we look for in managers that I love about these guys is, one is that they have really good infrastructure and engineering, and then two, I love managers that have been through tough times and have experienced you know, stretches of poor performance, because I feel like they're better seasons. When I see a manager that's only gone through good times, it's the old Mike Tyson saying, like, everybody's got a plan until they get punched in the face. I like to see the guys that have gotten punched in the face then have responded to that. But maybe both of you could talk a little bit about what I think is, you know, an edge that both of you carry, which is with respect to your infrastructure. And I know the guys at Wincent have spent a lot of time and resources into building their infrastructure up. And Srini and I spent a lot of time talking about that and really making sure we understood that before we allocated to you. So could you talk a little bit about that, Paul?
Yeah, I think we should have bought shares in Amazon, to be honest.
Yeah, right.
The amount of money we pay these guys every month, we could fund a few of Jeff's future weddings, perhaps. Yeah, I mean, infrastructure is critical for what we do. Shiliang mentioned about moving balances from exchanges into these settlement systems, which kind of replicate your assets onto the exchange. In the ultra-high frequency world where we operate, it is difficult to do that because you need to move those assets at high velocity between multiple exchanges. And so we have invested a lot in co-located servers globally. And we've only done that with really the top 15 exchanges. And we focused on having very strong relationships with those exchanges and partners versus, say, a Wincent who will connect to 200 exchanges. And so, I mean, I think our Amazon bill our AWS bill is I hope it's not 7 figures at the moment, but it's something crazy every month.
So how does that your approach to driving your latency down, how is that different or similar to what a high-frequency trader in the TradFi world might experience?
Look, if there are high-frequency traders in the TradFi world that want to join us, please come and meet me. We want to take all of that knowledge from the TradFi world and that infrastructure that we've been using in TradFi and put that into the crypto world. That's how we see this market going. And when you look at people like Citadel and others who are moving into this space, you'll see that happening and obviously eating away alpha over the next 2-3 years.
Great.
Yeah, I think for us, we don't operate in the ultra high frequency space. I think what we've done a good job of is basically aggregating over the years our own data in terms of alternative data, whether that's options data, derivatives data before there were vendors serving that, or DeFi data, on-chain data before there were vendors serving that, right? And really, understanding where that data is deriving from and cleaning that data, and then separately, I think the team that we've at least assembled is largely traditional, right? I think many of them have many years in crypto, but before then, spent many, many years in traditional markets at firms like Tower and others. And I think having that knowledge, especially as the space becomes more competitive and institutional, and eventually I think a lot of the rails in crypto will probably blur and blend with traditional market rails. Building for that, I think is extremely important.
So I think we have about 5 minutes left, and so I wanted to cover one or two other things, and if anyone has a question in the meantime, just raise your hand. Emil, you have a question?
Yeah, I have a question. The talk is that funding rates have sort of changed their behavior this year. There's been a lot of squeezes where market makers have taken out, have liquidated people, manipulating funding rates, and also funding rate ARB has sort of disappeared this year. Do you think this is, done? I mean, even in the recent rally, we haven't really seen funding rates take off like they used to.
Yeah, I mean, to your first point, definitely you pull up, a Binance account and you look at some of the Binance charts and coins. There are certain alts that randomly on a low liquidity time frame, call it Friday nights Eastern time or Saturdays, they somehow spike magically like 100, 200%, and the funding rates go to like negative 1,000% annualized. So a lot of that probably is like manipulation on like the tiny coins, right? But I think like with the funding, like in terms of like Bitcoin, Ethereum, I agree. I think like the market is very different now, and it alludes to kind of what I spoke to before. There is a lot more non-crypto native capital that is in, call it like Bitcoin and Ethereum now, right? And those are trading both on the CME, but also in crypto native instruments and exchanges. And I think that does change the behavior and profile and dynamics of how that, Bitcoin and Ethereum, at least derivatives, behave in market, I would say, in market conditions like what we've experienced the past year, right? And so that part of it is, call it whether it's like return compression or just a different pool of capital. It does make the behavior different now than it would have used to be, and doesn't mean that there's no like opportunities, right? I think like as the risks come down, I think like allocators and expected returns from allocators into this space comes down as well, right? No longer do you need the cash carry trade to return 20% plus annualized, 3-4 years ago because there are higher risks, versus now where you can basically replicate, the cash carry trade on the CME or, in better regulated conditions now, and so the hurdle rate has come down as well, and the expected returns as well.
So how do you, how does that impact your planning as you look forward in terms of running your fund?
Yeah, I mean, I think the philosophy doesn't change in terms of how we've moved cycle to cycle to opportunity, right? I think as certain markets and strategies become more competitive, we do have to evolve and push to other areas of the markets that are perhaps less competitive and less dominated by traditional pools of capital. And one of them is DeFi, right? We've continued to expand our exposure to the DeFi markets, trading there. And that's an area that I think the Citadels of the world probably won't touch, at least for the near future.
Yep.
Yeah, I mean, you've got to be responsive to the change of environment. So when the funding rates have dropped and you're not getting the returns from there that we're seeing, certainly for the first 7 months of this year, as we were previously, we've expanded into OTC trading. So we will provide liquidity to anybody who's looking to buy or sell crypto spot, any of the top 10,000 tokens. We've expanded into DeFi. We're expanding into options. And these 3 things as a fund, we weren't doing 2 years ago, 3 years ago. So that's how we're keeping ourselves ahead of that.
That's good color. So we got like 1 minute left. If there are no other questions, I have one more question. Maybe each of you, I'll just ask you, capacity. This is always a big issue with market neutral stuff. Obviously, you got Wincent has hit at least a timeout in terms of capacity recently. How do you think about that going forward, or how do you plan for that? I'll let you start.
Yeah, I mean, anytime you've got more than 4% of the market as your turnover, you're starting to notice an impact. Even at sort of 3% of the global market, you're starting to have an impact in reversion in your trading. So, look, I see this as a $4 trillion market going to 10 probably in the next 2 years. And that will allow us to then deploy more capital. We're not currently taking in capital because we don't want to have that just sat there idle. Hopefully we open up again. But a second thing that I want to look at is potential mid-frequency trading. So moving into leveraging our tech stack and existing infrastructure with some more medium frequency strategies that perhaps don't need that market to grow to $10 trillion.
Yeah, I can completely agree. And for us, I think we want to keep our alpha strategies and alpha funds relatively small, right? I think we have partners that we know have deep pockets that we can grow with over time. And so we don't want to just be an asset gathering business in these funds and compress returns. I think for us, like where we will focus on growing the asset base is more on these public treasuries, right? Not necessarily participating in all of them, but more managing the assets for these. A lot of these pubcos, once they raise the funds, they want to generate, outside of just tapping the ATM, they want to basically like generate high single-digit returns using the treasuries. And so examples are like we're going to be co-managers in the Reserve One Treasury. That's $1 billion treasury. There's a couple other treasuries that we're working with unannounced that'll be several hundred million. And those are more asset gathering businesses, kind of beta-like products and strategies that we can focus on. And then the alpha side of things, I think we just want to maintain a bare minimum floor of return for our LPs, so that they can continue to grow with us and be satisfied with the returns.
Okay, well, I think we're out of time now, and just want to thank you guys both for making a trip to Chicago. I think this was super enlightening for the investors, and thanks everyone for your attention.